I'm Connor Norris.
I'm Chip Keith.
Caleb Brainer.
Robert Everett.
I'm Tom Gross. I guess I'll give you the time today, 15 minutes each section. If you want, it'd be great.
I'm James Paul.
Are you ready?
Good afternoon. Like I said, I'm Connor Norris, the captain of our 2013 Federal Reserve Challenge Team. Today we're going to begin by giving a brief snapshot of the economy, followed by a look at the Federal Reserve's unconventional monetary policy since 2008, before giving you our policy recommendation. Our long-run goal is to return to traditional monetary policy after achieving a normal balance sheet without the mortgage-backed securities, agency debt, or long-term treasuries that the Federal Reserve has accumulated. Now let's begin with Robert and our current economic conditions.
Thank you, Connor. Starting with unemployment. Unemployment has dropped slowly to 7.2% and has dropped 0.4% since June, mainly because labor force participation continues to drop and is now at 63.2%. Jobless claims is roughly around 335,000, and non-farm payroll employment has increased by 148,000 in September. Core PCE is at 1.23%, and capacity utilization continues to rise and is at 78.3. Shifting to the housing market, mortgage rates are currently at 4.2%, while housing starts remain low at roughly 900, and Case-Shiller is up 12.8% from last year. Industrial production of durable goods is at 97.7, while industrial production of non-durable goods is at 93.9. Now moving to Lucas, quantitative easing 1 and 2.
Thank you. Prior to the large-scale asset purchase programs, widely known as quantitative easing, the Federal Reserve balance sheet totaled around $900 billion. Under QE1, the Fed bought $1.25 trillion of mortgage securities, $300 billion of long-term treasuries, and $170 billion of agency debt. These purchases totaled at roughly $1.75 trillion by early 2009. The Federal Reserve hoped to restore funds to the frozen credit market, help out the housing market, which was low since the bubble burst in 2007, and what was that? And communicate the intention of the Federal Reserve to keep long-term interest rates low. In November 2010, the Federal Reserve announced Quantitative Easing 2, which consisted of the purchase of $600 billion in long-term treasuries, and which the Federal Reserve intended to stabilize the recovery of the economy and also counteract the deflationary trends. After the first 2 rounds of quantitative easing, the Federal Reserve balance sheet rose to roughly $2.8 trillion, and now Connor is going to elaborate on quantitative easing 3.
Thanks, Lucas. Due to the continued slow recovery in September 2011, the FOMC announced a maturity extension program, which lasts until December 2012. The goal is to extend the average maturity of the Federal Reserve's SOMA, putting downward pressure on long-term interest rates in order to stimulate the economy. The program is balance sheet neutral in order to prevent the Federal Reserve's balance sheet from expanding like it did under the first 2 large-scale asset purchases. The Federal Reserve sold $667 billion worth of short-term treasury securities of less than 3-year maturity, while simultaneously purchasing $667 billion worth of treasuries with maturities ranging from 6 to 30 years. Economists such as Ben Bernanke and New York Fed researchers believe that the maturity extension program, work through the portfolio rebalancing channel, where the yields fall on long-term treasuries when the Federal Reserve buys them. This pushes investors into assets of higher risk but similar maturities, such as corporate bonds, providing financing for businesses in order to spur economic activity and employment. Canlin Lee and Min Lee found that the maturity extension program lowered yields on 10-year treasuries by 25 basis points. However, they do believe that the increase in federal debt at that time hampered the effectiveness of the program. As the economy continued to struggle, in September 2012, the FOMC announced the third round of quantitative easing with open-ended asset purchases that continue to today. The Federal Reserve is purchasing $40 billion a month in agency mortgage-backed securities in order to support the mortgage market. Meanwhile, they're purchasing $45 billion a month in long-term treasuries in order to further put downward pressure on long-term interest rates. This program has sold the balance sheet of the Federal Reserve to unprecedented levels. Since quantitative easing 3 began, unemployment fell from 7.9% to 7.2%, but the gains are mostly due to a decrease in the labor force participation rate, as Robert mentioned earlier. Conventional 30-year mortgage rates stayed low initially, but rose from a low of 3.4% to now 4.2% starting in June, due to mortgage lenders' expectations of the tapering of asset purchases by the Fed. A sell-off of 10-year treasuries resulted this June from Ben Bernanke's hints at upcoming tapering of the asset purchases. Chairman Bernanke gave the threshold for tapering of asset purchases at 7% unemployment and PCE inflation around 2%. But generally stable economic conditions and serious improvement must happen before they can taper these purchases. Although unemployment has fallen to 7.2%, core PCE inflation remains well below its 2% threshold. This, combined with the threat of government shutdown last month, which was a large shock to the economy, there's too much uncertainty in the economy for the Federal Reserve to begin tapering their asset purchases in the near future. Now, Caleb, if you'd like to take over the Fed's balance sheet.
Thank you. As mentioned by my colleagues, extensive asset buying programs have expanded the size of the Fed's balance sheet. Currently, the Fed holds over $3.8 trillion in assets. The continuation of further asset purchasing programs will expand the balance sheet further. In order to achieve a sound balance sheet, the Fed must stop buying the current assets that it is. In addition, the Fed must release the assets that it's currently holding, such as long-term treasuries, mortgage-backed securities, and agency debt. Tim will later address how we are going to relieve these assets from our balance sheet. In the short term, the Fed should continue following current forward guidance by tapering the rate of asset purchases when unemployment falls to 7% and inflation reaches 2%. After the Fed halts its asset purchases, we recommend they initiate an exit strategy that we will outline in shortly. So why exit? We want to signal to the market that the Fed is committed to its goal. In addition, we want our strategy to be concisely portrayed to the markets by sufficient forward guidance to minimize uncertainty. Tim, could you please elaborate further on our proposed exit strategy?
Sure. We propose a three-phase plan. First, we would like to sell the mortgage-backed securities through the open market operations, mostly because they are surrounded by uncertainty and controversy. Second, once those sales are completed, we would like to sell long-term treasuries and agency debt, also through open market operations. Once those sales are completed, we can resume traditional monetary policy. However, we would like to pick the target of 6.6 for unemployment, which is the natural rate as noted by John C. Williams, the president of the Richmond Fed. The current rate, as Rob pointed out, is 2.7. Expectations, however, remain optimistic. Dr. Charles Plosser, the president of the Philadelphia Fed, has noted that unemployment might reach 7% by the end of the first quarter of 2014. Additionally, Bloomberg says that we might reach 6.5 unemployment by the end of 2015. Our second condition that must be met is before we begin our exit strategy, is the 2% on inflation. Currently, that is at 1.23, as reported by PCE and Rob pointed out. The Cleveland Fed shows that the forward on inflation for 2 years will be at 1.7, with the possibility that inflation may reach that 2% threshold as early as 2016. Once we have reached those 2 points, we believe we can begin selling mortgage-backed securities. However, the uncertainty surrounding these assets makes us believe we should also keep an eye on housing during that time. We believe we should only continue to sell these mortgage-backed securities as long as housing prices do not show a drop of 3.5% during 2 consecutive months from a year ago. This is measured by the Case-Shiller 20 Metropolitan Area Index. As long as we see no drops that far, we believe we can safely sell these assets. Once those sales have completed, we can sell the long-term treasuries and the agency debt holdings. We believe we can continue to sell these at that point in time as long as unemployment remains below 7.3, which is the upper end of the natural rate of unemployment, and there is no fear of deflation and generally stable economic conditions as determined by the FOMC at that time. Once those sales are completed, or perhaps during, we can resume traditional monetary policy. It may be necessary to counter rising inflation rates as shown by expectations theory. And we also have the option to use interest rates on reserves. During the Great Recession, we saw banks had a tendency to increase their excess reserves. And the Fed introduced interest rates on those and can use that possibly in the future as an additional monetary tool in addition to open market operations and the discount window. Connor?
As Tim discussed, our long-run goal is to return a normal balance sheet without the mortgage-backed securities, agency debt, and long-term treasuries, allowing the Fed to return to more traditional monetary policy. Thank you for your time, and are there any questions?
Please start by just asking, what are the Fed's policy goals?
The dual mandate is controlling inflation and
Controlling inflation. Can you be more precise?
Stable price levels.
What does the Fed consider a stable price level?
usually between 2 and 4%.
Between 2 and
And what's that? 4%? Yeah, 2%.
While we're on the topic of inflation, what is the Fed's preferred method on gauging inflation and why are they chosen that indicator?
They chose core PC inflation. Core PC, they removed the most volatile of the products in the measure. I'm trying to think off the top of my head, I think like the top 15%, bottom 15% of volatility. It better accounts for like healthcare costs and it excludes food and oil.
And just go quick, fear of deflation. Explain what is the fear of deflation? Why are you afraid? Who's afraid of deflation?
Well, deflation is counterproductive for the market. You don't have inflation, but deflation is just as bad for the economy because it slows down production.
Just as bad as inflation?
Well, yeah. Actually, it's way worse than inflation. Deflation is the possibility of the deflationary spiral. If we see falling prices, that would spur buyers to hold off purchases. That can lead to that deflationary spiral where as prices fall, they just simply continue to fall as the economy slows down, as people simply hold on to their money in hopes of having more purchasing power in the future.
any other problems associated with deflation other than inflationary spiral, which is
And the same with investments too. We'd see the same problem with investment. There would be virtually no investment, as folks would just hold off as there'd be no return on their money.
all right. So you talk a lot about the exit strategy for the balance sheet. So this should first group that's first that today. So that's kudos for you. But you talk about asset sales. What's the alternative to asset sales? There's an alternative.
We could simply let them expire, let the maturity run out, and hold on to the proceeds.
What's wrong with
That would effectively remove some asset classes from the marketplace, which would be unprecedented. I believe that would cause us to lose confidence in the Fed.
Well, because assets going to mature whether the Fed has them or not, right?
Right.
So if that holds them till maturity, it's not, the outcome is basically the same as if they sell them to private individuals.
that they believe that mortgage-backed securities are losing in value a lot. And if that's the case, the Federal Reserve may, in fact, lose money on those investments, have negative remittances to the Treasury. And in that case, politicians will be calling to either audit the Fed or bring it more in line with Congress, give them more oversight.
So, if I can continue down this track for a little while, a lot of your presentations wrap up in this. So, I mean, you say you want to sell, one of which you want to sell is mortgage-backed securities followed by treasuries. What's the logic behind that? Can you just say that?
Yeah, there's a lot of uncertainty over what will happen when we sell the mortgage-backed securities. And in a lot of ways, it's very similar to contractionary monetary policy. If we're at such a time where we would need to initiate traditional contractionary monetary policy, that would, of course, begin to shrink the economy. But since the effect of the mortgage rate, or the mortgage-backed security sales is unknown, if it has a drastic negative effect, that can be easily stopped. That policy could be quickly stopped before there was too negative effect on the economy. If it went great and we could sell those without much problem, we could just move into continuing the contractionary monetary policy by moving on to things that are more stable, such as the long-term treasuries and the agency debt.
So like, correct me if I'm wrong, what you just said was that it's selling mortgage-backed securities produces a less uncertain, a more uncertain outcome. So why would you sell them first?
I want to do it at a time when the economy is at its most robust stage, as opposed to towards the end of the contractionary monetary policy, when we'd be thinking of either tapering or possibly beginning expansionary monetary policy, such as the economy would be in a recession. Doing that at that time might be even worse.
One more question on this issue. So you talk about returning the Fed's balance sheet to normal. What's normal?
What would be the prior levels before 2008, like 2006, like at 900 billion dollars. Whereas we don't have as much long-term debt to consider the graph.
We like the traditional holdings that we see prior to 2007.
So normal is just pre-2007.
Then, yeah, with the no main lane, mostly just made up of short-term government securities.
You touched upon the reinforced participation rate decreasing. What do you count for that?
Well, they believe there's several causes. First of all, there's a demographic shift. A lot of the population is becoming older as the baby boomers move towards retirement. And the older citizens have a lower labor force participation rate than do the younger citizens. And they believe that, I don't remember who wrote that paper. It's been estimated that between 2007 and 2012 that this demographic shift is half the change in the decreasing labor force participation rate. There's also increased secular effect on the participation rate. As during this recession, there's been a lot more long-term unemployed. As people are unemployed longer, their skills deteriorate, and it's more difficult for them to find jobs, so they often drop out of the labor force.
Switching gears a little bit, in terms of the transparency of the Fed, they've obviously recently been more transparent. What is the effect of that?
We believe that shows more confidence in the Fed and also leaves less uncertainty in the market, as the Fed has been quite liberal with forward guidance. The market knows where it's going and its policy goals.
Is there any drawbacks to that recently, or to the transparency?
I'm sorry?
Have there been any drawbacks recently, or have there been any drawbacks to the transparency?
I can take that. And, well, yes, like in June, when the market believed that the tapering was coming, because there were any hints in the future, if they misunderstand what the Fed's trying to say, or they try to use information to like make guesses about what the Federal Reserve is going to do, then that could have negative consequences, and that could hamper the Federal Reserve's policy.
Which brings me to another question in that same vein. So when I look at your policy, Seems like there are an awful lot of strings attached to it. This, if this, if this, if this. That was kind of what I heard. Am I mistaken?
No, I'm doing this, right? Yeah.
So, how transparent do you think that approach?
I'd say that's very transparent. If we're going to tell the market exactly what we're going to do, given these,
Can you put up one of your recommendations then?
if we can.
Measure 6.6, keep out. This one. No fear of deflation, generally stable economic conditions. How will we know when we have generally stable economic conditions? How will the market know when
All right. Well, as we've seen, Congress, most importantly, has been driving us towards the fiscal cliff on a pretty regular basis. So that has done much to give us not generally stable economic conditions. And the time frame of this is certainly unknown. So we leave that a bit vague, as the FOMC will have to certainly have many meetings to decide if we're seeing generally stable economic conditions, or if we are on the brink of another fiscal cliff, or giving a lot of uncertainty to the economy through fiscal policy, not so much monetary policy.
Because, the reason I ask these is, the Fed is now, or has been in this debate between rules and discretion, right? So the state contingent forward guidance, which is essentially what you're talking about. The way it's supposed to work is, the market can easily anticipate where policy is going to go. So keep the Fed funds rate at 0 until the inflation rate goes, I don't know, below 6.5%. That's a very clear demarcation. Generally stable economic conditions hold interpretation. So I think that if I were offering that kind of advice, I'd want to be much more specific about what I mean by generally stable economic conditions. Because beauty is in the eye of the beholder, right? Stability is in the eye of the beholder. What you find stable, I might not. So the Fed talks in those kind of vague terms, makes it difficult. You're being transparent, and you're sending a signal. But it's a signal that's difficult for the market to interpret. And that's sort of, I think, what Tom was kind of referencing there, in the sense that transparency need not always be a good thing, it can be a bad thing. If the signal that you send is kind of a mixed signal, a confused signal, signal that's difficult to read. How are we with time? What's that?
If I could say something to that, what we are trying to avoid is handcuffing ourselves to a policy with something like the government shutdown occurring. Or that would have a drastic effect on the economy, and we don't want to say that we're going to begin tapering purchases or we're going to start a contractionary policy when the economy really needs something else because of that shock. They really don't anticipate.
So what I keep saying is you want to preserve discretion, right?
Yeah, totally.
Yeah.
Absolutely.
You can't be entirely rules-based.
Okay, so
What our plan is.
So you want to mix it back, right? You want to preserve some discretion.
A little bit, just.
We're gonna pull it off.
Okay. Well, this is the essence of the rules versus discretion debate, right? The idea is you want to tie yourself to a rule, but tie yourself to a rule, it gets you in trouble. So you want some slippage in there. But then the impact of the rule is weakened. So that undercuts. And, it's an open question as to, this is a debate that's going on to this day, very lively, right? Rules versus discretion. And I guess my point is, if you think discretion is that important, what is the benefit of the rule? Especially if, you have unemployment was below 7.3%. So if I look at that rule, I can interpret it to say, well, unemployment goes below 7.2%. But economic conditions will be stable. So, what do you think?
Correct.
So, I'm sort of wondering what the value of that 7.3% really is. Because really what it seems to come down is the zero economic conditions.
Sure, yeah. We're gonna have to catch all at the end, and, yeah. And I gotta agree, I mean, that's kind of the way we gotta play it, if it is an atrocious situation.
Well, that's the way the Fed's been playing, right? They're very hesitant to tie themselves off fiscal bandwagon and start to go downhill, then wherever you want to create this, you don't want to take